Good morning. Welcome to a What's Up with the Market session. This is our second of the year. I did one a week and a half ago, and we're going to have a look and see what the markets have done since. Before we do that, I have to tell you that everything we covered today is general investment advice, and there's no specific or personal investment advice. Right, now that done, let's get into the analysis. First of all, we'll start with where we always do, the Dow Jones. And when I've last discussed the Dow Jones with you, and even before the break, the important thing that had happened is the Dow Jones had broken above this black dotted resistance zone. That black dotted resistance zone represents the all-time high, which goes back to 2021. There we go. And this is the first time or second time that it's actually, the second time since it made close to that high and or touched the resistance zone, and it's broken above and it's staying above. And this is the important thing. So this is one of the things, one of the indices that we're watching closely. We're looking for retracement here, and when the retracement happens, how deep it goes. The other point I wanted to make here is this run up that we had pre-Christmas, and then the pullback that we had is that pullback was 38.2 to around about 38.2% Fibonacci retracement, which was pretty normal given the run-up that we had. So that's normal. And then we had this December run-up, which was a steep run-up. And now we're looking for another pullback, another retracement. That would be a normal thing for the market to do, and we would expect that to happen. So what we're looking at now in all these indices as I go through this is how deep that retracement is. And we could even have a sideways movement without a retracement and in a new breakout. If that happens, that would indicate very strong price action. So the point we're looking at here is the Dow Jones remaining above its all-time high, which is represented by this resistance zone, or now support zone, the black dotted zone that I have there. S&P 500 is a little bit different. Same dotted resistance zone, and it still is a resistance zone. It hasn't yet turned into a support zone because it hasn't broken above it. So there, back in 2021 is where, 2022, late 2021, early 2022, it was around about that area. Arrived here again, reached it again, and hasn't broken through yet. So I'd like to see all of the indices, and I'm going to talk about 4 indices now. Typically it's 3, but I've brought the NASDAQ 100 into it as well because it has broken above its all-time high. So we're going to keep an eye on Dow Jones, S&P 500, NASDAQ Composite, and NASDAQ 100. So that's what we're looking at. We're looking at this breakout. Now, this run up in December, very strong and steep breakout out of this down channel over here, the downtrend channel, and a shallow retracement. Now, we are still in the retracement. Why? Because we haven't made a new peak yet. So it's so we've had a higher low. There's a higher low, higher low. That was strong. You see the sideways movement here on the S&P 500 when it got to a bit of resistance. Didn't retrace, continued higher. Now has had a very shallow retracement. In this period, the Dow Jones has had no retracement. It's basically just gone sideways and remained above its all-time high. So these are key. These are very key technical analysis, charting, price action techniques that we're looking at here. For the upside, the case for the upside here is we would need to see the S&P 500 break above this resistance zone and stay above it. Might come back and test it as a support zone, but we need to have that breakout first. For the case for the downside is that the S&P 500 does not break out and has a deeper retracement. And if that is the case, we would want it to find support at this blue support zone over here, which goes all the way back. Pretty strong support zone, was a resistance zone. So that's what we're keeping an eye on over here over the coming weeks. There are a lot of people predicting the wall of worry problems that are going to come to the fore. Some breadth of market indicators, cumulative new high, new low. What we look for here is divergence, similar to what happened here. So we're looking for the gray line to start falling while the blue line continues. The blue line is the S&P 500. So we're not seeing any divergence here. So no signs or way we can use that chart. Similarly, with the Cumulative Advanced Decline Line, we're looking for what happened here, top left, where the index continues higher, but the Advanced Decline Line falls. And also looking for a combination of the falling, but also being below this 55-day exponential moving average. So what we have at the moment is the Advanced Decline Line is rising and above its 55-day moving average. So at this stage, that's a positive breadth of market indication at the moment, even though we've had a little bit of a downtick here at the end in the gray line, the advanced decline line. Nothing goes up or down in the straight line. So keeping an eye on that, but that's positive at the moment. Right, on to the next one, which the number of stocks in the S&P 500 that are above their 150-day moving average, still up at the 70% level. So that's pretty high and indicative of, from a breadth of market perspective, that most stocks are rising. Okay, on to the NASDAQ. This is the US dollar index. Very high negative correlation to the S&P 500. And I'll just zoom in here and just pick on this the price action here. First of all, I'll just move clear chart and just look at the raw price action. There was a big uptick in the US dollar overnight in its session, and that's strength. So we got the US dollar rising here, and this is a basket against a number of currencies. But if we go to, let's just go to side panels and we go back to our analyses and bring that back up. What I'm looking for, because one day is not what we should put all our focus on, is looking at some smooth indicators here. And this green, the line, this falling Ciroc over here, which is really it's a smooth rate of change indicator on this relative strength line. What's this relative strength line? It's comparing the US dollar index to the S&P 500. So the blue line, the S&P 500 rising, the trend is still down on the US dollar index. But we've now had this breakout, that the price action that I showed you. You can see the little uptick, the green bar just above it there. So I know it's one day, but the trend line is broken. Very early indicator. We don't work on one day breaks through a trend line. And that's why I have the smooth indicator over here, just starting to flatten out. So at this stage, a very early sign of strength into the US dollar index, which could be signaling a bit more weakness in equities, but it's only one indicator, 1 sentiment indicator. We don't put all of our eggs into that one basket, but it is an early sign, and there is a very high correlation between US dollar and negative correlation, that is, and the S&P 500. So let's now go to growth, the Russell Growth Index versus the Russell Value Index. The top chart here is the growth index. You can't see the value index here. It's basically in this calculation, this line, this blue line here, which is the relative strength comparing the two. It's a ratio, and whilst this blue line has just ticked up a bit, that's telling us that just in these last week or so, the growth is outperforming the value. We have had the green line, which is a smooth, it's a 34 days exponential moving average is falling. And I've got an indicator of the moving average just to get some smoothing here. And this drop out of from above 90 on the Ciroc is telling us that the trend is it's likely that value is going to come to the fore here. Of course, it's a smooth indicator, and it does tries to smooth out the little up and down rises and falls on a short-term basis. So whilst we have an uptick here in the short term in the ratio, the trending indicator is indicating that we maybe have some weakness in growth compared to value, which is one of the sentiment indicators we use, which is a little bit negative as well. So we've got some negativity coming through in that. Sorry, I keep pushing the wrong page down. Right, let's look at the next sentiment indicator, which is consumer discretionary versus consumer staple. The smooth line over here is showing that it's risk on. So this is a positive sentiment indicator. It's broken out of this down channel, and it's showing that discretionary stocks are stronger, relatively stronger than over a medium-term outlook than a consumer staple. But we do have this downtick over here, just in the blue line at the end. It is just above, or it's just fallen below the moving average. So a little bit of negativity there in the short term, but the medium-term outlook is still that there is strength coming from discretionary compared to the consumer staple. Right, put call ratio. We have here is the put call ratio is this is risk on. So the green line over here, that's Ciroc falling, is showing that calls are over the medium to longer term are stronger. Buying of calls is stronger than buying of puts, which is a bullish sign. So this is risk on. It is flattening out down here. It can stay below the Ciroc for some time. And you can see this 250-day moving average on the put call ratio It's just ticked up, but it is, you can see it's slanting down over there, which is why this stock is falling. So in the short term, there are some tiny negative grassroots coming through in the negative in the sentiment indicators. But the medium to longer term, which is really what we've got to look at, that's what we were looking for, trends in that time frame, is still positive in these. Okay, let's go now next to the next sentiment indicator, which is 10-year treasuries. 10-year treasuries, there's that downtrend, which is good. So effectively, what's happening is when the trend is down, there's the ratio falling. That means that 10-year treasuries are underperforming stocks, so bonds underperforming stocks. And that's why we get the Ciroc falling over here. So there's the S&P 500 in the bottom chart. So I've got a green line there with the Ciroc falling, meaning that that bonds are underperforming equities. But another little indication here, that ratio is flattening out there, as are the other ratios, the other sentiment indicators I looked at. You can see there's an uptick here of 10-year bond, the 10-year treasury yields, and the last session was also a green bar as well. So a little bit of short-term positive movement in 10-year yields, which has a negative correlation to equities, and that is why we got that ratio. So another little tiny negative there, bit of negative sentiment towards stocks. The VIX index had a jump overnight with the indices falling. So another little bit of negativity there in the case for some weakness in stocks just lying ahead of us. The NASDAQ Composite is still in its uptrend, which goes all the way back to the end of 2022, so about 14 months worth. But it did give an exit signal using our mechanical system. It still is risk on, so this is a relative strength line here compared to the S&P 500, and I've got a medium to longer term Ciroc on this to try and pick the bigger picture trend. It's still risk on. If this falls, then we'd have a risk off. So it's a little bit dicey there as well. There's certainly not lots of strength coming through in that ratio between the NASDAQ Composite and the S&P 500. I'll just go back to the NASDAQ Composite. Oops, what's happened there? There we go. I just wanted to point out that the NASDAQ Composite is not above its all-time high. So we have the Dow Jones is above, the S&P 500 is at its all-time high, at its resistance zone, whereas the NASDAQ Composite is below it. So we'd like to see for the case to have a really good, strong bull market is this index also to be above its all-time high. So it hasn't got there yet. Onto the NASDAQ 100, which is why I've brought this in here, is because, and there's its all-time high back in late 2021, and it has risen above its all-time high. I'll just zoom in here, and I'll just go down and back up. It is still above. So it went above the all-time high, fell down below, found support. I've now, with that point, that trough over there, I've put this channel line in over here, and it is still above its all-time high. So we have 2 of the 4 indices we're tracking here above their all-time highs. We'd like all 4, but they're not there. And of course, a fall below the all-time high in both the Dow and the NASDAQ 100, and then a steep fall off would obviously be negative. But while they're above all-time highs and staying in the trend, in the channel, there is the case for bullish, if you like, for being in the market is still, and having exposure is still strong. But as I've said, some of the sentiment indicators are showing a little bit of negativity. This is the risk on. So right back here in February 2023 is when the the NASDAQ 100 started outperforming the S&P 500. This is a ratio line, a relative strength, relative comparison to the S&P 500, and there is the Ciroc of the ratio line still staying risk on. So there's a bit weakness, but certainly the indication is that there's still strength. This is the new high, new low on the NASDAQ, and this is on the NASDAQ 100, and you can see it is rising over here. So no divergence there yet. The Cumulative Advanced Decline Line on the NASDAQ 100 in sync. A little bit of fall off over here. That there's not, and this again it's short term, but the trends are up here, and we will keep an eye in the next session about further weakness in the Advanced Decline Line, but a little bit at this stage and not enough to sway our decision making. If you're a discretionary trader, which I should take the opportunity now to say that, of course, I'm doing discretionary subjective technical analysis here. And I don't use any of this in my decision making for my portfolios that I manage both in the US market and on the ASX. I'm 100% mechanical and follow the mechanical signals on the individual stocks and run portfolios almost like a mini fund and compile those entry and exit signals and then run a portfolio of stocks that have simultaneous open positions. Right, having said that, this is the NASDAQ 100 stocks above their 150-day moving average. This breadth of market indicator still high. So that's supporting, if you like, the bullish case at this stage. The semiconductor sector, I've compared this to the NASDAQ Composite down here. This ratio line rising means semiconductor index outperforming the NASDAQ Composite. There's risk on there. This is a trend indicator of the ratio line. And sure, there's been a higher highs. There's now a low just formed there, and it's a higher low. And in the session of just completed in the United States a couple of hours ago, the semiconductor sector index was up, and that may be because of a strong price action. I think AMD was up 8%, and that's in this index. So strength there. And I think Micron was also up as well in a down day. So strength in semiconductor index at the moment, which is, from a sentiment perspective, a bullish sign. Right now, onto the dog's breakfast, which I was reminded of, the Ordinaries. This is a very, very messy chart. I've got a relative strength line here compared to the S&P500. A little bit of positivity there in December, where it actually rose by more than the S&P 500, which had a good December as well, but now weakness, so underperforming just there. Basically, S&P 500 going sideways to slightly down, but the All Ordinaries falling by more. Big red bar on the previous day. And I should have pointed this out on some of the other indices. When you have so that's going back to the 3rd of January, basically the first trading day of the year, was it? Let me put a value line on and clear it up. But that was the 3rd of January and second trading day of the year. And it's a big red bar, open half, finished lower. Now I'm going to go back and look at the NDX and just have a look at that as well and see what happened. There was, just before the new year, big red bar on this, and the All Ords reacted to that, and open higher, fell lower, but has found strength since. But the All Ords has not. It's got weaker. So we'll keep an eye on that, but it's now right at this resistance. It's close to its all-time high, just below it. That's what the black rectangle zone there, dotted zone, all-time high. And not looking that strong at the moment relative to the US markets. But sorry, I should also say it did have a run up, so we are expecting a retracement. Now we want to see how deep that retracement goes. Anything less than a 23.6% retracement will be positive for let me explain that. I'll just get my Fibonacci line up and I'll just put that on. So what we're looking at is this retracement remaining at less than 23.6. It's already at 23.6. So 8.2 is really where we would want to arrest this short term. So sharp run up, and the 38.2 would still be positive. Getting to a 50% retracement of this run up would not be positive. The US markets aren't anywhere near their 23.6% retracement yet, but you could also do that for short term analysis as well. Right, moving on to the Australian dollar. Weakness here, sell signal via the US dollar, and that's on the strength of the US dollar. So also indicative of strength in the US dollar. Right, the Nikkei. I'm just going to quickly change my period here to go all data, because that is relevant to the Nikkei. The Nikkei's had a breakout, as you would have seen there, but there is its all-time high back in 1989. There it is, back there. And it's just 38,000 something. And it's spent the best part of, 35 years below its all-time high. So this is effectively drawdown. So we've had an index here in drawdown for that long, for 35 years. Now, just zooming in, I'll just change my period back to 25 years. This is a significant breakout. It's higher. This chart goes back all the way back to 1999, so 10 years after now that I've taken a 25-year period, and it's the highest high it's had in a quarter of a century. And that is a strong breakout. You might have heard me talking about that's why I've put a black dotted line here, although it's not the all-time high. It is relative to the last 25 years, and it's good. And this blue line here, this blue zone I've got here, does go back all the way to 1989. So it was also a resistance zone back then, which was a resistance zone on the way up and a support on the way down, which it broke down through. So this is a significant breakout. This is strong price action. This is 3 gaps in a row. So it's a breakaway gap, some consolidation, and it's going to be interesting to see what happens with the Japanese stock market relative to others, because it is undoubtedly going to attract some money, some international funds money. You can see the relative strength here over this period of time against the S&P500 has been strong. So it's one to keep an eye on, and it's also one to talk about, because there has been for years a discussion about a strong correlation, or a decent enough correlation between the Australian market and the Japanese market. Why? I can't find any reasons, but there is. And so let's keep an eye on that and see if it flows through into the rest of it. Might just be APAC, and that's a close enough reason. But when these correlations happen, they don't stay there forever. But when they do happen, we should follow through on them and keep an eye on it. So we'll be doing it in some of the analysis we do coming up over the coming weeks and months. So this is the DAX. The DAX is another index which is above its all-time high. So its all-time high was back in also late 2021, back there, and bounced off it a few times, didn't get through, and broke through here in December, early December, after that strong rise. Has consolidated. That's more of a consolidation than a retracement, and is holding support above its all-time high. So let's keep an eye on that as well. And I think that is the last one we want to look at, the FTSE. So we'll finish there on the indices, on equities, and now we'll go over to commodities. CRB index is basically going sideways. It's struggling to break through this resistance zone here. It did there, fell back into the range, and is in a downtrend. Is underperforming. So commodities underperforming equities. That's that falling. We know equities are hanging around. They're not the S&P 500. That's the relative comparison there. Is going sideways at the moment in the short term, but commodities falling. Gold we'll keep a very close eye on this all-time high. That is its all-time high achieved back here in 2020, and a number of attempts to get through. 1, 2, 3, 4 you can count, and it's probably going to have another go. The trend is sideways, I would say. It's fallen out of the rising channel here. My view on this is that while we're in a secular bull market, which I did in December, is that gold's not going to have a big strong trend like it did to go to its all-time high that it reached in 2020. It's going to. So there was the run up there. That run up, we in a secular bull market, it's going to struggle. Gold will do best in secular bear markets. So and we're waiting now. If the gold does break out, because as I've said to you many times before in the secular bull market sessions, is that it's very difficult in the short term to pick that the secular bear market's actually started. One of the things, and I'll keep on reminding you of this, one of the things we'll keep an eye on is maybe an early indication that the secular bear market has started, is a breakout in gold, and a strong breakout in a rising price. That might be one of the green shoot indications of a secular bear market starting in equities. But if resistance is found here and gold falls away, then that's going to be in the case of keeping the secular bull market in equities keeping on raging. As you know from my analysis that I did in December, that could still go on for a number of years if we repeat the secular bull markets that we had in equities in the early 1900s and from 1982 through to 2000. Silver, nothing to report there. On copper, copper did break out of its downtrend, but is now found resistance and is also now looking at finding support at the upper channel line. A textbook technical analysis will tell you it does find support there because it's broken out of the channel, which was quite a long channel, and will then test 400 again. But in the short term, it's still sideways to down. Oil is sideways to down as well, still in the down channel, which is leading into the weakness in the CRB index, and oil underperforming equities at the moment. The Bitcoin is given a sell signal on, still in the channel. Let me just go back. Let's just do that again. It's still in the channel. There's the rising channel. Fell out, got back into the channel. Still finding support there. Still support at this support zone, which was a resistance zone. Battle to get through. Broke out above. Fell back into it. A positive session in the US session. But looking at a medium to longer term, or a short to medium term indicator here of the Ciroc on the relative strength is that we've got a sell signal here. Sorry, that's not a Ciroc on the relative strength. That is a Ciroc on the raw price action. So the sell signal there in the short to medium term. Let's see what happens with that. The same with Ethereum. Ethereum hasn't, or did give a bit of a sell, bit of a bumpy over here. I don't trade this mechanically with this indicator, but if you were, you would have got in and out over here a bit. But it's back into the trend channel, and also rising. So a bit more strength in Ethereum than Bitcoin, but it was weaker for a while. Okay, just to finish up on the commodities, uranium continues to show strength. This relative strength line here is telling me that the uranium price is outperforming the ETF URA. Very poor tracking there. That should be a straight line if it was tracking the uranium price, but it doesn't. So, and obviously we'll leave it there. But there's a breakout above the 50 percentile here of the Fibonacci retracement, and that is quite strong. So strong price action here. You can see that the gradient of the trend is getting stronger. Uranium ore is in demand. Iron ore is also broken above its this 125 zone over here, which is quite an important support resistance zone. You can see it's got plenty of touches on it and risen above it, and is now, so we're going to see a retracement. It's a strong movement, and that support at 125 does need to hold. It's also broken out of that grey channel, that trend line, downward trending channel line there. So there's strength in iron ore, and obviously that should augur well for the larger iron ore miners in Australia. And lastly, what we will look at is thermal coal. Support resistance bouncing between these two zones here. Found resistance there, and looks like it might go all the way back down to this level over here, which is about 100. What is it? Sorry, I'll just have to check with my value line. It's around about $125, $123 there. So there is some strength in some of the commodities, but also weakness. But the CRB index is falling, so the commodity to stock index ratio is that stocks are stronger at the moment. Right, let's do some questions. I'll just go back to the S&P to summarize before I do that. Bruce has asked, how do you use these early warning signals to assist your mechanical trading? Is it a case of don't be surprised if some sell signals come through? That's exactly it, Bruce. So there's no hard and fast decisions that get made. The decisions come purely from the raw price action in stocks, and it's just really for people, as much as in the 4-week in the training intensive that I did, the process plus mindset training intensive, is where we talk about not having an expectation and just trading in the zone, not associating with the past, not projecting and expecting into the future, not predicting. Is people want to know, right? And so I do these sessions. They're popular, and it does give people a bigger picture view of what's going on. So yes, it does give you a bit of a picture to not be surprised if something happens. It can build into your psyche, and hopefully it just, with a bigger picture view of what's going on and how all these intermarket sentiment and breadth of market indicators work, and how they give us some early warning signals in both directions, is it just makes it easier for you to be a mechanical trader. That's really why I do it. It is interesting. I mean, people want to know what's going on. As long as we don't and translate that into trying to know what's going to happen in individual trades, and also into a portfolio that you manage as a fund. So you shouldn't be selling totally out of this based on some negative sentiment indicators or breadth of market indicators. And what we've got to be is trade in the zone. We've got to be in the now moment, and we've got to go to the price action of the individual stocks. And that's what we want to be mechanical about. We want to be, this is noise, effectively. You hear me talk about noise all the time. This is part of the noise. And you're going to be hearing noise from everywhere else. You just can't turn it all off. So I'll spend some time providing some noise too, that hopefully gives you a better insight than just, and as an objective a way as I possibly can, using subjective tools. But hopefully it's a lot more objective than the noise you'll hear with people writing words and giving personal opinions. So sure, I've got these are personal opinions that come from experience, but I'm trying to go to the price action all the time and be as objective as I can with every indicator, whether it be sentiment, breadth of market, or a price action indicator, as I possibly can. And hopefully that just kind of makes it easier for you to discount emotional stuff, emotional noise that you might hear from some other sources, and just give you a more realistic, objective view, using subjective technical analysis tools. So hopefully that answers your question. Right, XC, if we just want to watch one single metric, what would it be? Well, to question, one straightforward single metric that you look at, and it depends what your objective is, but if your objective is to manage your own money and make decisions, it would be, in the case of SPA3 Investor, it would be the breakout line. So that's what you would use. We now risk, so entry and exit, so buy and sell signals, timing if you like, and risk management you'll use technical analysis to do that. And obviously with SPA3 Investor, we are 100% mechanical. So on the individual stocks, you'll do your timing and risk management based on that breakout indicator. Now that's got some other technical analysis built into it. It has volatility built into it. It has raw price action built into it. And it has a number of things. So that's the one thing. That's what I look at, 100%. That's all I look at on individual stocks every single day as to whether I should buy, hold, or sell. And there's been weeks go by. There's a sell signal on Fortescue FMG to close those trades today, which I'll do in my personal portfolio and in the public portfolio, and that's what we'll do. So that's easy. At a portfolio level, risk management at a portfolio level, with SPA3 Trader, we have market risk signals on that where you would sell out. You're not taking any new entries, but we're a SPA3 Investor at the moment. We don't have that, but we are researching it at the moment, and so that would be risk management at the portfolio level. And of course, then you have money management, and your money management is purely your position sizing in your individual stocks. And those three of timing, buying, selling on individual stocks, risk management on individual stocks, and the portfolio and money management is effectively all you need to focus on. There shouldn't be anything else you need to focus on once you have a mechanical system and an objective, non-discretionary, unambiguous way of making decisions in the market. And to go along with that, to make that easier, you need to retrain your mind to be able to execute that way. Now, people will say, it's so hard to execute a mechanical system. Well, with the 30 plus years experience I've got, it's far more difficult to execute a subjective, opinionated system. Or I can't call it a system, that's an oxymoron, but process, I guess, if you like. So that's the one thing. That's the one thing that we'd focus on. And the more people talk about weight of evidence. Now, weight of evidence of what? This is a little bit of a weight of evidence session where we're looking at breadth of market sentiment and raw price action and some trend and support and resistance analysis. Those are basic things, but there's a whole weight of evidence there that could weigh positive or negative, but it's subjective, it's feeling, and it's emotional. We don't want to do that when it comes to making decisions in the market with hard and fast money. And we want to be as objective and unemotional and unambiguous as possible. And so that's where I don't subscribe to the weight of evidence at all. Why? Because it can just create confusion. You will be able to take a weight of evidence, of indicators and data and skew it to whatever your notion is that you have in your head at any given time. And we don't want to do that because that just pulls you from pillar to post, makes you subjective, and you don't, and in the moment, you then start doubting and having confusion. And there's no ways you can be a good decision maker with lots of doubt, uncertainty, fear, and confusion around. We want to get rid of all of that and be firm and follow a plan that we've devised before we start executing. A little bit of psychology there, but thanks for the questions and that little bit. It's very important that we do the psychology. So I'll end up there. So we're watching, just in summary, we're watching the Dow Jones, the S&P500, the NASDAQ Composite, and the NASDAQ 100, with a little bit of a view on the Nikkei and the DAX. So we've got the Nikkei, in inverted commas, at an all-time high, but in the last 34 years, if you like, and very close to, it's only 2,000 odd points off its all-time high from 1989. And we're also looking at the DAX remaining above its all-time high, the Dow Jones remaining above its all-time high, and the NASDAQ 100 remaining above its all-time high. And for the NASDAQ Composite and the S&P 500 to get above their previous all-time highs and stay above, that's the bullish case. And of course, if we get price weakness and it falls away and all those that are above their all-time highs fall back below and into the range, then that's not going to augur well for stocks, and we'd anticipate weakness from there. I'll finish up there. No more questions. There's a general comment from Jermaine. The 4-week process and intensive mindset training is an excellent tool. Thanks, Jermaine. We've had some great feedback on that. There's been some Google reviews on it, if you feel inclined, please go and put a Google review on our Google page, and yeah, we'd love that, because it really, that social proof, it just gives people confidence to, first of all, go and do the training, because it really is, in my view, the best training that I've ever put together with Dave, the preparation of and the delivery thereof. And sure, if you have questions about that, if any of that challenges you, then please call us. We'd love to help you through it. And hopefully you're getting followed up with by Jane to take accountability of any new customers that have signed up recently. It's just imperative that you do the 4-week training intensive. Thanks, Don. And we'll finish it there. And as always, I wish you consistent, objective, and peaceful active investing.